All right, hey guys, hope everyone's doing well. So CPI data coming out today, headline and core. So interestingly enough, month on month, analyst forecasts are actually expecting disinflation. So it's an important figure to take note because for the most part of this year, analysts have been sort of forecasting a more hawkish inflation rate. And now this is the first one that we're getting actually some disinflationary. We'll talk a little bit about as to why analysts are actually forecasting that. And obviously we markets trade on expectations, so if we do beat this forecast, let's say if it was a positive number, um that would be very, very bullish for the dollar, and vice versa. If we come in extremely soft, then that would be very bearish for the that would be very bearish for the dollar, excuse me. Yields will start to drop as well. Why? Because, well, if inflation is easing, that means the current rate that we're at is actually putting pressure in the market. And at the same time, there will be less of a need for the Fed to really hike any rates. I don't think they're going to cut rates this year, but there will be less of a need for them to actually hike because they're actually seeing inflation ease, right? And for the most part, institutions are still looking at rate cuts in 2027, and we're already kind of halfway throughout the year. Now, is it always this simple? No, right? Why? Because, well, events, things can happen, and that's essentially what we're having right now. So my point is we're getting some escalations back on the market, right? We're seeing Iran and the US basically fighting it out, hashing it out with each other. And we're seeing the Strait of Hamas now pretty much back to where it was very early on in the beginning of this war in February. Now we're at 2.5 million barrels per day passing through. We were almost literally at 80% at one point, and now we're at 12%. So we're disrupted for sure. This is definitely affecting markets. And as long as this escalation continues, inflation is probably going to still be a problem. And why is that? Well, for the most part, inflation has been an issue because of oil, right? Obviously, if you block the Strait of Hamas, that's going to create a choke point. Oil can pass through, prices are going to rise, lack of supply. It's just, it's not a simple demand and supply dynamics, right? And what we can see is that in the beginning of this war, prices rose extremely high in a couple of days to as high as 112, right? And that was the highest price throughout this war. And then for the most part, we started to ease, right? Because we started to get some truce, we started to get some positive sort of feedback between Iran and the US, and then they decided to actually sign the truce. They were very happy, everyone's rejoicing. And obviously, when that happens, right? My narrative as well was the US dollar may not have a need to hike rates. I mean, this whole inflationary story probably is over, right? And I want to start to look at more bearish dollar, and initially, look, we start to get that, right? We're starting to see some weakness in the dollar. If we bring out the US economic heat map, we're gonna see that the main things that called out to us was we got weaker NFP numbers, right? So we started to see some easing in the jobs data. PMIs also started to ease. I mean, not by much. We're still above the 50, right? So it's still growing, but it's growing a little bit less. And unemployment rate came in better, but it wasn't really coming in better because there were more jobs per se. It's just that the labor participation rate started to reduce, and the market started to see that. The market started to price that in, and they're starting to see a macro shift, just like myself, right? I'm not saying that the dollar is 100% bearish just because of some of these weaknesses, but when we start to get more weakening data over time, then that's gonna really drive the dollar lower, right? There's really no need for any sort of rate hike, right? Because the dollar is already getting affected. Doing that would cause the dollar to weaken even more, would cause more problems from an economic standpoint towards consumers, businesses, etc. It's just not going to be great. Okay, so for the most part, that was the narrative that was at. With lower oil prices, pretty much at one point at very close to pre-war levels, pretty much, right, at the resistance area. Um, we had 1 year inflation swaps being weaker, being pretty much at the lows. Uh, but interestingly, we didn't really see the 2 year yield really move much. Okay, for the most part, right? So bond markets are still pricing in. higher rates, right? They're still uncertain. They still want a higher risk premium. They don't fully trust that this war is over, and I guess they're right. Because we're having escalations again, and that's why we broke out to new highs. Now, markets are demanding for higher risk premium, right? And if we take a look at the crude oil price, we can actually see the first proper pullback after this pretty intense, few week ease. 1, 2, 3, 4, 5, 6 weeks of just downtrends, right? And now this is the first time we're getting to see that the market is starting to look more bullish on oil, right? So, oh, sorry. Right here, there's the Fed. You can see that markets are, this is based on market pricing of 2020 by 2026, by the way. We can see that markets are actually pricing in higher rate hikes by end year, right? We were at one point only at about 20, about half of this amount, and now markets fully priced or increased their bets for a 44% basis point, right? Hike, not 44%, sorry, 44 basis point hike by end year. Right now, what does this mean? Well, I don't wouldn't use this as a figure to trust because it can change over time. But the point of how we want to visualize this chart and how we want to understand it is that the markets are actually becoming more hawkish. That's how we want to look at it, right? This was during June, right? So markets started to price in during the FOMC meeting. So markets price in a lot more hikes during that meeting. So we had a huge spike, and then for the most part, we were pulling back pretty muted. And now with the escalation, we're seeing a potential increase of hawkish repricing in the market. So markets are, obviously this is based on a forward looking, it's a leading indicator. Markets are hawkish, right? So interesting to take note. And what I also would like to focus on as well is if we take a look at let's see here. The federal funds rate. So this is the federal funds rate, the yellow line, the orange line, excuse me, and the 2-year yield is the blue line. What we can see is, I wouldn't use this as a forecasting tool, but what we can see is that when the yield market, your yields market has been very strongly correlated with the Fed funds rate, right? We can see as the Fed increased their rates, so did the yield market start to move. But most of the time, the yield market is going to move before the Fed actually hikes rates, right? Because the bond yield market is, it's more of a forecasting kind of mechanics. They're looking forward, right? I wouldn't say it's a forecasting tool, excuse me, but they're looking forward. Everything that they're pricing in is forward looking, right? It's not backward looking. And what we can see is that with the recent escalations, we actually can see that the yield market is pricing in for higher prices, higher interest rates, more hikes this year. Now, does this mean that the bond market is right? No. Does it mean that they're wrong? I don't know, right? But I think the most important thing to understand is why are they doing this? Okay, because of the escalation. And if there is, this escalation, excuse me, the duration of this escalation continue for longer, that's going to be a real issue. Okay, that's going to be a real issue for inflation. Um, I would say that that would probably also lead to, as inflation starts to get stronger and starts to get affected because of that escalation, then the Fed might be a little bit more hawkish, right? So that's how we want to understand the markets, right? So if we try to break it down here, what we understand now is that oil is basically at $80 per barrel, right? I mean, for now we're a little bit lower than that, but we're pretty much at 80 at this point, right? And where we were at pre-war levels were around the 60 range, and now we're still elevated. Okay, don't get me wrong. Like it doesn't have to be elevated only if it's at 100. Like it's still elevated even right now. So that's one thing, right? Analyst consensus are expecting still disinflationary, but that's based on what? Old data. That's based on data from the past, right? But what we can see here is if oil prices stay at these levels, escalation that is driven by longer duration of this escalation, things get worse, then what comes out today, I still think it will come out weak, or at least as expected, or maybe a modest. I mean, okay, it kind of seems like I'm I'm not giving a really direct answer. Well, I'm not really going to try to predict, right? But I think it's if I really would to predict something, or my opinion, I would say, I wouldn't call this a prediction. I would say my opinion is that it might come up pretty modestly. I don't think it would be a crazy move, right? A lot of the inflationary data is obviously backwards, right? It's all from the past. It's not talking about current inflation. So this explanation that I'm trying to explain, or this explanation that I'm trying to tell you guys, is more towards the next reading, right? And so if we start to continue this escalation, oil prices continue higher, the next inflation reading after today, so next month, likely will be very, very hawkish, will be strong. And I think that will change the narrative again. And then I think the US dollar is going to continue for higher prices. That's what I think, right? So it all comes down to one simple thing: the escalation. Are we going to get this the escalation soon, or are we not going to get the escalations, right? Right now, we're not getting that, okay? And if I may, I feel like it's worse today, okay? In terms of the escalations, right? That actually, the war is actually happening, right? Literally, they're both fighting each other. And by they, I mean the US and Iran, right? So, so yeah, but nonetheless, we are trading based on what's going on, what's happening right now. So I think what's important is just to watch how price reacts. That's the best thing that I can say. Watch how price reacts. Don't jump in. Don't rush into anything. Wait for the data to come out and see how it reacts, right? If there's some sort of anomaly happening, that's going to be a very strong tell sign that maybe the markets are expecting something else, right? So a lot of the times, what we see on the chart here is going to be more forward looking, right? Markets trade based off expectations, okay? And what we can see now is markets are expecting for high inflation, okay? Maybe not in this inflation reading, but they're expecting for high inflation over time if this escalation continues, right? So I've been long this since yesterday, trying to, trade with the I guess you can say the escalation, right? Oil prices moving higher. This is great for the cat. Uh, I'm also in the pound Australian dollar. Fundamentally speaking, there's some real strength here, but as you can see, it's not doing extremely well. Why? Because, well, it's inversely related. CAN and JPY to GPB AUD is about 70% inversely related. So why did I do that? Well, it wasn't really me trying to hedge. I was really just trying to trade the fundamentals, the macro, which is what I really focus on. But obviously, with higher oil prices and things like that, this pound Australian dollar trade wouldn't be the top of the list, right? Because Australian dollar is a risk-on asset. With higher oil prices, that goes for high inflation. High inflation affects risk on currencies, which is what Australian dollar is. The pound is more of a hybrid, like the US dollar. Um, and so yeah, so CAD to the yen is basically just piggybacking off the oil move. So if we do get higher inflation readings, I would say that it will be quite bearish for the CAD to yen, but it will be quite bullish for um the pound to Australian, because the Australian dollar, like I said, if there's high inflation figures, that's going to put more pressure on risk on assets, right? So Australian dollar is going to weaken a lot more. The pound, uh, not necessarily because it's a stronger currency per se. Obviously, I think from a fundamental standpoint, it still is, but in terms of beats and the expectations versus actual, but it's more because of the fact that if higher inflation numbers come in, then Australian dollar is going to get weaker. Now, the thing is, I may get stopped out before CPI reading, so we'll see. But yeah, so but if we get a softer US CPI reading, I think for the CAD UN is going to be a bit mixed. It can still be bullish. Um, if stocks rise, if oil holds, because Canadian dollar also benefits from risk on mechanics. Um, but it turns bearish if US yields strengthen even more. Or sorry, excuse me, if falling US yields strengthen the UN even more, right? Because of the softer US CPI reading. So, so it's kind of mixed. I think it's hard to say what will happen if we come with the soft US CPI reading. Um, I guess the other potential point or scenario that could happen, excuse me, a potential scenario that could happen as well, is if we get a softer CPI print, but oil prices are still elevated because of the escalations, and markets are not really pricing or focusing too much on this current figure because this figure is old news, and then the CAD can still move up. So it's a very difficult situation, right? However, for the pound to Australian dollar long, if we get a softer US CPI reading, that would be bearish for the pound to Australian dollar. That would be great for the Australian dollar. that would, a softer print would support more risk appetite for risk on assets, which will help the Australian dollar even more, right? But more or less, these are both completely inversely related trades, strongly inversely related. So either one is probably going to happen based on what the data comes out. So we don't fully know, right? Nobody can fully predict. We have an understanding of the mechanics, but mechanics, uh, markets are very complex. Okay, so we don't know what can fully happen, right? So, but that's the trade I'm in right now. Other than that, I'm really not looking at anything else this week. I mean, I do have some trades that I wanna potentially take a stab in, like the euro. Oh my gosh, look at that. So the euro to the kiwi is something I'm looking at. We are going away from what we wanted. I was hoping for some sort of pullback. We're not getting it, unfortunately. That's fine. Euro GPB is kind of consolidating now, but this was a really great move. Just didn't get a pullback. It's so weak. There was really barely any kind of pullbacks in this trade. I'm still looking at the Euro NZD for shorts, Euro GPB as well. Euro is just super weak right now on every level. Um, NCD has been very, very hawkish, obviously, as you guys know. So I think there's going to be a lot more great longs on the Kiwi front. Um, but we may be a little bit late to it. So just be very, very careful trying to long into the run of this NZD move. Pretty much even NZD Swiss franc, look at that crazy move, barely any pullbacks. And this is on the 4-hour chart, by the way, which is insane. If we bring it to the 30-minute chart, look at that. Some might say that this is the stock market, right? But yeah, it's crazy. NZD AUD, I would say it's also stronger, right? So you can see the Kiwi. I mean, we talk about the Entropidians. I think that's how you call it. Um, NZD is a lot stronger than the Australian dollar. It's really where the focus is. And yeah, I mean, I wouldn't mind trying to still long it into some sort of pullback. I just think that it's super overextended, and I would love to get a little bit more of a deeper pullback for me to continue that wave. We'll see. Um, Euro USD, I already got out my trade. It just doesn't look like it's moving. It's so weak right now on the Euro front, so it's okay. We'll just wait, right? What we want to do, and this is something that I really want to focus on, at least for the next few, I mean, for the rest of the year or for the rest of my trading journey, to be honest with you, is I want to focus on really taking less trades, taking better setups. Yeah, that's kind of the goal that I'm focusing on now. Trade less. So I am going to stop trading the lower time frames. I think for those who have been watching me for a while, I usually take entries on the 15-minute to 5-minute. In this particular market, it's really tough to do that. You're usually gonna be open to more cuts. It's better to just stick to the stick to the high time frames, right? Stick to the daily, stick to the 4-hour entry, no lower than on a 1 hour. All right, have a bit bigger of a stop loss, so it's just a lot more stress free. And if you do have a solid trade, then look to scale in on the lower time frames. That's my take, and see what happens. All right, but that's anyways. Those are the goals today, and that's kind of the end of the video. So yeah, I appreciate you guys for tuning in. All right, cheers, guys.